So you want to deduct home mortgage interest. Hi, Bob Jennings here. Let's talk about this deducting home mortgage interest on your personal tax return. 5 main points to be able to deduct that interest. But before we do that, let's clarify one of the most common misconceptions in America. You are never ahead of the game having a mortgage on your home. As an example, we do not have a 100% tax rate. If you pay $1,000 interest on your home mortgage, the highest tax rate currently in the United States is 35%, which means the most that you can save out of that $1,000 is $350 on your tax return, so you'll still be out $650 out of pocket in cash. All right, so now that that's out of the way, point number one to deduct your home mortgage. Point number one is that the home has to be legally secured by the loan. The loan has to be attached to the home, legally filed with the courthouse. Now, what does this mean? For most of us, it means nothing. You buy your home, you finance it with a bank, the bank secures the mortgage at the courthouse legally, and you get to deduct that interest. On rare occasions, some people will buy a home on contract. That means that the seller is financing the home for you. If the seller has recorded that deed at the courthouse, you get to deduct the interest. If they have not, you don't get to deduct it. And finally, third on this first point, if you are borrowing money from a family member or friend to pay for your home, unless that family member or friend secures that loan by filing a lien against it at the courthouse, you're not allowed to deduct it. So point one, the loan must secure the home. It must be legally filed at the courthouse. Point number two is an easy one. In order to deduct the interest, the home must qualify as a home. What does this mean? Things like homes, RVs, boats, motorhomes, anything that has eating, sleeping, and restroom facilities and that is your primary place of residence will qualify as your home. So point two, eating, sleeping, and restroom facilities, and nearly anything qualifies, again, including RVs and boats. All right. Point three, you must make the payments. Well, that seems to make sense to just about everybody, but what's an example of why I wouldn't be making the payments? What if, as a gift, your parents decide to make home payments for you? Well, since you did not make the payments, they're not allowed to deduct the interest, nor are you. Why can't you deduct it? You didn't make the payments. Why can't they deduct it? Because the loan is not in their name to secure your home. So it would be better in that situation for parents to give the homeowner the money as a gift and then the homeowner make the payments. So point three, the point three is that you have to physically make the payments. Point four is really our two limits. IRS in point four and point five limits the amount of interest we're allowed to deduct. Point four says we are allowed to deduct interest on up to $1 million of money that we borrow to buy, build, or improve the home that we borrowed the money against. I'll say that again. You're allowed to deduct interest on up to $1 million of money that you borrow to buy, build, or improve the home that you borrowed the money against. Okay? Easy enough? For most Americans, no problem. But in recent years, as we've seen a lot of refinancings, think of this. If you refinance your home and you don't use the refinancing to buy, build, or improve that home, then it doesn't qualify under this test. All right, so what does it qualify under? Our fifth and final point. You're also allowed to deduct interest on up to $100,000 of money borrowed for other purposes. So if you refinance your home, let's say you pull $70,000 out of your home to add on a room, and you spend the entire $70,000. Well, that money actually fits under the $1 million test. So for most homeowners, we don't have a problem. However, what if you refinance your home, or you have a home equity line, and you pull $70,000 out to pay for a child's college, buy a car, pay off a credit card, buy a vacation home, any of those things? That falls under the $100,000 limit. So let's summarize. 5 points to be able to deduct the interest on your home. Point number one, the loan must be secured against the home. Point number two, the home has to qualify as your residence with eating, sleeping, and restroom facilities. Point number three, you must actually make the payments. Point number four, you must have borrowed less than $1 million in total against the home to buy, build, or improve that home. And point number five, you're allowed to borrow up to another $100,000 against the home for non-residential purposes, non-use for buying, building, or improving, and deducting that interest. All right, well, for further questions, please visit us by seeing our website at the bottom of the screen in front of you or calling us. I want to thank you for watching. Bob Jennings signing off.